Have you ever wondered why some investors swear by index funds while others advocate for mutual funds? What if the key to maximizing your returns lies in understanding the subtle differences between these two investment vehicles? Stick around as we unravel the mysteries behind these popular investment options and help you choose the right one for your financial goals. Welcome to our channel. In today's video, we're diving deep into a topic that's crucial for anyone looking to start their investment journey: the comparison between index funds and mutual funds. Whether you're a beginner trying to understand where to put your money or an experienced investor weighing your options, this video is going to provide you with all the essential insights you need to make an informed decision. What are index funds? Let's start with index funds. An index fund is a type of mutual fund, or ETF, exchange-traded fund designed to replicate the performance of a specific market index. The most well-known example is the S&P 500, which tracks 500 of the largest companies in the US, but there are many other indices, such as the Dow Jones Industrial Average, NASDAQ Composite Index, and Russell 2000, each representing different segments of the market. The key feature of an index fund is its passive management. Unlike actively managed funds, where fund managers make frequent buying and selling decisions, index funds simply aim to mirror the performance of their chosen index. This means that an index fund will invest in the same stocks that make up the index, in the same proportions. One of the first and most famous index funds is the Vanguard 500 Index Fund, which tracks the S&P 500. Since its inception, it has delivered an average annual return of 7.84% since 2000, closely matching the index's performance. Pros of index funds: lower fees. Since index funds don't require active management, they generally come with lower fees compared to mutual funds. Diversification. By investing in an index fund, you're effectively spreading your investment across a wide range of companies and sectors, reducing your overall risk. Dependable returns. Index funds tend to offer slow but steady returns over time, making them a solid choice for long-term investors. Minimal research required. You don't need to be an investment expert to benefit from index funds. They're designed to be easy. Cons of index funds: lack of active management. Because they're not actively managed, you don't have any control over the specific companies you're investing in. This could be an issue if you have ethical concerns about certain businesses. Limited short-term gains. Since index funds are designed to match the market rather than beat it, your potential for short-term gains is limited. What are mutual funds? Now, let's talk about mutual funds. A mutual fund is a company or investment vehicle that pools together money from multiple investors to invest in a diversified portfolio of assets like stocks, bonds, or other securities. Unlike index funds, mutual funds are typically actively managed by professional fund managers who aim to outperform the market. There are several types of mutual funds, including money market funds, bond funds, target date funds, and stock funds. One of the key attractions of mutual funds is the potential for higher returns, especially when managed by skilled professionals. Take, for example, the Fidelity Magellan Fund, which was managed by Peter Lynch from 1977 to 1990. Under his management, the fund delivered an average annual return of 29.2%, significantly outperforming the S&P 500 during the same period. Pros of mutual funds: diversification. Like index funds, mutual funds also allow you to diversify across various companies and sectors. Potential for higher gains. When managed well, mutual funds have the potential to outperform the market, offering higher returns. Variety of options. With several types of mutual funds available, you can choose one that aligns with your investment goals and risk tolerance. Cons of mutual funds: higher fees. Actively managed mutual funds come with higher fees, including management fees, administrative costs, and other expenses. More research required. Choosing the right mutual fund can be challenging, as it requires more research to find a reputable fund manager. Higher risk. Because fund managers actively try to beat the market, mutual funds can be riskier than index funds. Comparing index funds and mutual funds. Now that we've covered the basics, let's compare index funds and mutual funds side by side. Management style and objectives. Index funds are passively managed and aim to match the returns of a specific market index. This approach is low cost and low risk, making it ideal for beginners or those looking for a hands-off investment strategy. In contrast, mutual funds are actively managed by professionals who aim to outperform the market. While this can lead to higher returns, it also introduces more risk and unpredictability. Costs and fees. When it comes to costs, index funds are the clear winner. Since they don't require active management, their fees are generally lower. On average, the expense ratio for an index fund is around 0.15% compared to 0.42% for equity mutual funds. However, mutual funds come with additional costs for management, legal, custodial, and administrative services. Risk and return. Index funds offer steady, predictable returns over time, which is ideal for long-term investors. However, they are unlikely to outperform the market. On the other hand, mutual funds offer the potential for higher returns, but with greater risk. If the fund manager is successful, mutual funds can significantly outperform index funds, but if not, they may underperform the market, making the choice: index funds or mutual funds. So how do you choose between index funds and mutual funds? It all comes down to your investment strategy, risk tolerance, and financial goals. If you're a beginner or prefer a hands-off approach, index funds might be the better option. They offer low-cost diversification and consistent returns, making them ideal for long-term investors who want to minimize risk. On the other hand, if you're willing to take on more risk for the potential of higher returns, actively managed mutual funds could be the way to go. Just be sure to do your research and choose a fund managed by a reputable professional. It's also worth considering a combination of both. Many investors diversify their portfolios by holding index and mutual funds. This way, you can benefit from the steady returns of index funds while having the opportunity for higher gains with mutual funds. Both index funds and mutual funds have their unique advantages and disadvantages. The key is to understand your investment goals and risk tolerance before deciding. Whether you choose the steady, passive approach of index funds or the potentially higher returns of mutual funds, both can be valuable tools in building a diversified investment portfolio. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you never miss an update, and let us know in the comments which investment strategy you prefer, index funds or mutual funds. Until next time, happy investing!